Welcome to Tikona Capital FinServe's Market Outlook for March 2025. I'm excited to share our comprehensive analysis of current market trends, opportunities, and strategic insights that will help you navigate today's dynamic investment landscape. At Tikona Capital FinServe Private Limited, your investing co-pilot, we provide comprehensive wealth solutions for working professionals, HNI clients, and family offices. Our services include equity model portfolios, mutual fund solutions, differentiated PMS offerings, unique AIFs, unlisted equities, startup investments, and IPO advisory services. Our philosophy centers on creating finite solutions in an environment of infinite financial possibilities. Important disclosure: investments in securities are subject to market risks. Please read all documents carefully before investing. This presentation should not be considered as investment advice. Please consult your financial advisor before making investment decisions. Past performance does not guarantee future results. For information and detailed disclosures, visit our website at tikonacapital.com. Our March outlook focuses on the global crosscurrents of uncertainty, where inflationary pressures, geopolitical risks, and volatile capital flows continue to test investor sentiment. We examine whether valuations reflect reality, if the recent correction signals a bottom, and how India's domestic strength can offset external vulnerabilities. The month's spotlight remains on central bank policy cues, equity performance trends, and identifying resilient opportunities amid shifting market dynamics. Globally, the theme remains uncertainty. In the US, stubbornly high inflation coupled with surprisingly strong economic growth is forcing the Federal Reserve to delay its much-anticipated interest rate cuts. This higher for longer rate scenario is creating headwinds for global liquidity and keeping investors on edge, contributing to the volatility we've witnessed. Adding to the uncertainty are the renewed threats of a global tariff war. While much of this is political noise, the mere possibility is fueling fears of a growth slowdown and even recession in the US. This policy flip-flop is a primary source of global market volatility, as it creates unpredictable cross-border trade flows and currency movements. This macroeconomic uncertainty is directly impacting the ground level. US consumer sentiment has begun to fall from its peaks, and month-on-month personal spending growth is showing signs of softening. When the world's largest consumer economy shows caution, it sends ripples across the global economy, affecting export-driven markets and corporate earnings expectations. This global anxiety is reflected in Indian boardrooms as well. Many Indian business sources are expressing concern about the macro environment. The top worries remain the triad of inflation, unpredictable trade tariffs, and the political uncertainty surrounding US policies. This caution is causing businesses to be measured in their expansion and capital allocation plans. CEO surveys reveal significant concern over the macro environment. Fears of inflation, trade tariffs, and policy uncertainty under the Trump administration are driving this caution. This pessimistic sentiment is directly translating into market softness, creating a clear overhang on NIFTY's performance as investment and growth plans are put on hold. Globally, responses vary. Europe is attempting to counter its economic struggles with renewed fiscal stimulus measures. Meanwhile, China is facing a unique situation where domestic investors are seeking opportunities outside of China, despite strong industrial data. China has become the world's largest car exporter, and its industrial sector, not just real estate, is a key growth driver. The world is grappling with a complex, multi-speed economic reality. China's industrial sector is emerging as the key growth driver, even as real estate remains under pressure. Strong exports in automobiles and machinery have made China the world's largest car exporter, supported by rising industrial lending. This shift signals a move away from property-led growth toward industry-led momentum, reshaping global supply chains and creating new sectoral opportunities. Markets in February 2025. In February, this global narrative played out in markets. China and Europe, due to stimulus and attractive valuations, actually outperformed. In contrast, the broad-based benchmarks of India and the US, like the Nifty 500 and Russell 2000, underperformed as they priced in the uncertainty. Notably in India, the Bank Nifty began to show signs of outperformance, a key trend to watch. During the corrective phase, large-cap funds outperformed across categories, offering relative stability. Thematically, international equities and credit risk funds were bright spots. In a telling sign of the risk-off sentiment, gold was the best performing asset class for the month, as investors sought safe haven assets. Market activity tells a story of domestic resilience. Foreign institutional investors, or FIIs, were net sellers, reacting to global yields and uncertainty. However, domestic institutional investors, or DIs, continued their buying spree, demonstrating strong local conviction. This domestic support is crucial and has helped cushion the market from deeper falls. The correction was also felt in the unlisted space, which often acts as a leading indicator. Many pre-IPO stocks saw moderate to sharp corrections, with names like Metropolitan Stock Exchange and Matrix Gas falling significantly. Interestingly, we saw a sector-specific shift. Investor interest moved away from solar and green energy stocks towards more stable exchange-related businesses, highlighting a flight to quality and predictability. Opportunities and market outlook. So, what caused India's slowdown? A combination of factors, the anticipation of general elections and a below-normal monsoon created caution. This was compounded by a deliberate slowdown in unsecured credit due to tight liquidity measures by the RBI. Furthermore, government expenditure was slow to pick up, temporarily reducing a key growth engine. However, it's crucial to view this slowdown as a pause, not a reversal. India's fundamental story remains intact. We remain the fastest growing major economy in the world, and our inflation is steadily falling. This powerful combination of high growth and moderating inflation is a magnet for long-term capital, and we expect it to attract flows back into Indian assets. We are already seeing early signs of this recovery. Real GDP growth improved in the third quarter of 2025. The key driver was a six-quarter high in final consumption spending, at 7.1%, showing both government and private consumption are reviving. A strong contribution from net exports also helped, signaling improving global demand. Other high-frequency indicators confirm this turn. Growth momentum in the 8 core industries has started improving after a period of slowdown. More importantly, GST collections have re-accelerated, pointing to robust formal sector activity and strengthening government revenues, which can fuel future capex. The recovery is being led by a revival in government capital expenditure and remarkably strong services exports. While goods exports face global headwinds, India's services exports continue to show stellar growth, diversifying our economic drivers and providing a structural buffer against global trade volatility. This macro recovery is translating into corporate performance. Corporate India is signaling a clear revival in profit growth. After several quarters of moderation, earnings are surprising on the upside. Notably, mid-cap companies have shown the strongest rebound, indicating that the broader market's health is improving. This sets the stage for a powerful cycle. Unlike past downturns, Indian corporate balance sheets are exceptionally strong. This strength is anti-fragile. It allows companies to invest ahead of the curve, gain market share, and drive growth even in an uncertain environment, turning a challenge into a strategic opportunity. From a macro perspective, the interest rate differential between India and the US remains competitive. A potential low interest rate regime in India, coupled with the RBI's proactive liquidity measures, could be another anti-fragile moment, making domestic borrowing attractive and supporting investment-led growth. From a market perspective, the correction has made valuations much more reasonable. The Nifty, after its decline, is now close to its long-term historical average valuation. Excluding mega events like the global financial crisis or COVID, the market drawdown is in line with historical averages, suggesting the bulk of the de-rating may be behind us. Time is also a factor. Historically, such corrective phases have lasted an average of about 6 months. The current correction is now close to this typical period, suggesting we may be nearing the end of this cycle from a time perspective as well. A key concern has been massive fee outflows. In absolute terms, the outflows have been significant. However, when viewed as a percentage of the total market capitalization in their holdings, the picture is less alarming. Fee ownership is near a decadal low, meaning their dominance as a seller is reducing, and the market is being supported by strong domestic flows. Market breadth, which measures how many stocks are participating in a move, has deteriorated to levels typically seen near market bottoms. This is actually a contrarian indicator. It suggests that the panic selling is widespread, and many quality stocks have been sold indiscriminately, potentially creating a bottom for a large number of companies. The froth has certainly been taken out. Small and mid-cap valuation multiples have softened considerably from their euphoric highs. While they may still be expensive relative to large caps, the correction has made the space much more reasonable. Going forward, performance will be driven less by valuation expansion and more by actual financial earnings delivery. To summarize the valuation picture, PE multiples have corrected reasonably from their peaks. The Nifty is now trading near its long-term average, making large-cap investments particularly compelling from a risk-reward perspective after the correction since September 2024. Another macro valuation metric, the market cap to GDP ratio, has declined sharply for large caps from its all-time highs. However, it's important to note that mid and small caps continue to trade near their highs, indicating that the valuation comfort is still predominantly in the large cap space. India's contribution to world market capitalization remains strong and is on a long-term upward trend. This is supported by a fundamental shift in market ownership. As fee ownership has dipped to decadal lows, de-ownership has bridged the gap. This means Indian markets are increasingly driven by domestic savings, making them more resilient to global fund flows and volatility. Technically, our analysis suggests that the Nifty has largely completed its course of correction related to the recent global uncertainty. The chart shows a potential completion of a downward pattern, suggesting the worst of the global-led sell-off may be behind us, and the market is now looking for catalysts to move higher. So where is growth coming from? Corporate India is pivoting towards three key engines. Urban consumption is reviving, government capex is picking up momentum, and exports are finding new markets and incentives. Sources are bullish on these themes, focusing on new growth areas driven by policy support and changing global supply chains. Sector performance is beginning to diverge as the recovery takes hold. Large-cap banks and NBFCs, both private and PSU, are well positioned with strong balance sheets and improving credit demand. Consumer durables and discretionary segments are showing early resilience, supported by urban demand. Select mid-caps are rebounding strongly, while new-age companies that deliver earnings surprises are regaining investor confidence. On the other hand, small caps remain expensive, requiring careful selection. Overall, sectors tied to domestic consumption, financials, and infrastructure stand out as constructive opportunities, while export-heavy or overvalued pockets demand caution. The Indian markets faced unexpected slowdowns in early 2025, but the second half is shaping up more constructively. Liquidity support, falling crude prices, and stronger corporate earnings are providing a foundation for recovery. Government capital expenditure and policy support remain strong drivers, while resilient consumption underpins growth momentum. Valuations in large caps have corrected to attractive levels, whereas mid and small caps still look stretched. Global trade tensions and tariff risks remain external headwinds, but India's low goods to GDP exposure makes it more resilient. For investors, the message is to gradually raise equity weights, favor large caps, financials, and select mid caps, while staying alert to global risks and volatility. At Tikona Capital Finserv Private Limited, we believe in creating finite solutions in infinite possibilities. Our triangle logo represents filtering out unknowable edges from the ultimate circle of market uncertainty. Founded and led by Sumit Poddar, our team is committed to empowering customers to invest in high-quality businesses and build long-term wealth. Connect with us at tikonacapital.com, follow us on LinkedIn, YouTube, and Twitter. Thank you for watching, and remember, invest with conviction, build long-term wealth.